All right, as we're opening up and participants are joining, good afternoon and welcome to today's ATI member exclusive training and education facilitated by GovMates on the topic of R&D tax credits. We're going to dive into all of the really good stuff here ahead of the tax deadlines in just a moment. But I am your event host, Meg O'Hara, GovMates Director of Engagement, and I'll be monitoring the Q&A, facilitating the discussion. But for those who may not know, GovMates, we are a technology scouting platform who connects small and non-traditional businesses with system integrators and agencies who are seeking solutions to their federal challenges. So we provide matchmaking, training, and education like this, resources, and more for all of our ATI members as well as our ecosystem. So before we jump into the super good stuff that you're actually here for, I'd like to provide you with a few participation reminders if this is the first time that you are joining us. So first things first, remove those distractions. We're going to try to keep this to about an hour. So if you can, silence your cell phone, close down your tabs that you have open on your devices, try to stay out of your email if you can. This is a perfect excuse to eat some lunch and not answer your phone. Sorry, I'm on a webinar. That always works pretty well. Second thing is we do encourage you to be active in the chat. So you should see a Q&A at the bottom and a chat box on the bottom right-ish of your screen. You can use it to say hello, let me know that you can actually hear me. But make sure you choose all panelists and attendees or everyone. Otherwise, I'm going to be the only one who sees what you're saying. But we will be taking audience questions. And if something is relevant to the group at large, we will be sure to touch on it here. And if your question is a little bit more nuanced or specific, we will be happy to provide a way for you to connect with our presenters in a more in-depth discussion after the presentation. So finally, there will be a recording. We always get that question. There will be a recording. Once that is processed and posted, if you'd like a copy, all you have to do is reach out to ati@govmates.com, and I will be sure to share that email address later on as well. So this is where I get to do a brief introduction. Actually, they get to introduce themselves of our panelists today. Carlos is going to be first. Thank you for joining me. And second, please tell me a little bit about who you are and what makes you an expert in your field.
Yeah, Carlos Freitas. Thank you, Meg, for a brief introduction there. Carlos Freitas with Knarr. I'm a partner here at Knarr. I've been in this world of R&D tax credits and specialty tax credits in general for a little over 18 years. I started when I was 12, for those of you guys who were wondering. And it is, the R&D credit really takes a special set of skills and experience to be able to be a specialist in, and that it really is a mix of engineering and tax at the same time. I'm a degreed engineer, an electrical engineer. I graduated from Purdue. And our expertise in engineering really facilitates getting to the right answers for the R&D tax credit. Knarr has been around for about 22 years, it'll be 22 years this year. And the R&D credit has really been the major focus of Knarr, although, as I said, we do other tax credits as well. Some of you guys may know the employee retention credit. The cost segregation was another service that we provided some time ago. And local and state incentives, as you guys will hear a little bit about later on.
Perfect. Thank you. And John, you are also here with us today. Can you give me a little bit about who you are and what it is that you do?
Yeah, absolutely. I just want to say thank you again. I always say Carlos is the face. He gets to use his expertise to actually generate the credits for our clients, but I kind of look at my role as business development manager. I get to talk to a lot of prospects, a lot of clients, hear kind of what's going on, what people are being told. There's a ton of misinformation out there about the R&D credit, which we kind of believe that our sole job, first and foremost, is to help people understand what the actual regulations are. I think, a lot of people get them at the surface level, but when you dig a little bit deeper, you actually get the real answer. So that's really what my job is to kind of work with those companies and give them an idea of the lay of the land so that they can help make the best decision for their situation. And sometimes that's a no, and that's perfectly okay. So first educate, kind of work with them on that, and then let them make the best decision for them.
Perfect. It's all about doing the right thing and making sure that people are informed to make good
Absolutely.
decisions. So we like that. So as far as our agenda today, we're going to chat through the R&D tax credit overview. We're going to talk about section 174 that you may have heard about, and that is very important for you, and also what you can do today to set your business up for success. So I'm going to turn the talking over to Carlos and John. And so don't forget to put your questions in the Q&A and we'll monitor that throughout. And Carlos and John, the floor is yours.
Yeah, I'll take over from here. So just a little bit about who we are. Carlos mentioned this earlier. We have been specializing in the R&D credit for more than 20 years. You may be wondering why the employee retention credit's in here. There is a connection to the R&D credit as it pertains to 2021 specifically. And so it's an area we've been helping our clients with here now for a few years, and other state and local incentives. So whether that's hiring, whether that's capital investment, things of those areas, those are ways that we've been helping companies identify non-diluted funding. Just a little bit of story about ourselves too. I mentioned our approach, our engineering-based approach. We have engineers. Carlos is an engineer. I am not. I'll be perfectly honest with that. But no, we have degreed engineers on staff. And just as a little backstory, Hall & Knarr was actually founded by David Hall. He was a non-degreed engineer and was actually working at an accounting firm. At that time, he was in charge of identifying new business opportunities for the firm, and they were doing some R&D credits for companies. And at the end of the day, he went into an audit and identified as an IRS agent walks in that the IRS agent was a degreed engineer. And so he went back to the firm and said, "Hey, listen, we need to have degreed engineers performing these studies for our clients." And they said, "We're not degreed engineers, we're accountants." And so he then spun off and created Hall & Knarr. So that's how we started. And that's why we go with that approach. It is something that it mirrors the IRS process. And we just know that at the end of the day, it's going to improve documentation in the event of an audit, while also on the back end increasing the return that companies get. I mentioned this before. But we can work with the company, accountants, accounting firms trust us that don't end up taking care of this themselves. And then also venture capital firms, other strategic advisors of that nature. We assist all those different types of groups in helping these companies get that benefit. Most importantly, we are not an accounting firm. You do not want us to do your taxes. This is actually, the R&D credit is an engineering function. It just happens to be on a tax form. So we'll always start there and say that when it comes to this, we are there to support you and also support accounting firms, but we are not one. So that's a good distinction between the two. So I know Meg was working on this. We are going to start with a polling question. We always like to start here just because it gives everybody a good lay of the land of kind of things that we can add into the presentation, maybe ad lib, if you will. But we'll just start when it comes to the research tax credit. Which best describes your situation? Is it something you don't know about the credit? Maybe you were told that you didn't qualify, claim the credit, but don't include anything other than what you guys do in internal IR&D, or you're of the belief that you're maximizing the credit. If you guys could answer that. We'll just get a lay of the land, and then we'll turn it over to Carlos and let him run through the presentation.
So far, I've got about 43% say they don't know. 14 are split between was told that we didn't qualify and they claim the credit but don't include anything, and 38% are maximizing the credit. Perfect.
No, I think that's a good. That generally falls right in those extremes, and then some in the middle. So that's great.
Awesome.
Perfect. Carlos, I'll go ahead and turn it over to you.
Yeah, I appreciate it, John. Interesting results there to the polling question. So what I'm going to do then is give you guys a little bit of an overview, just because there's so many of you that really don't know much about the credit. Let me start there. I'll make this quick for the sake of the other ones. But on the ones, the 38% that said you're maximizing the credit, feel free and please do encourage you to put some questions in the Q&A there, as far as things that you guys want to know about the credit. You're here, you maximizing the credit. What are you hoping to get out of this presentation? What are the things that you want to get clarified? If you're maximizing the credit, what's your interest in the presentation, and what else do you want to hear from us? John will monitor those questions, and I'll jump in with some answers here while we're going through the overview that hopefully you guys already know, since you're maximizing the credit. But for those that haven't really heard much about the credit, or maybe you're split, I don't know, we kind of have talked about it before, but we're told we don't qualify. Let me give you guys a brief overview. So the credit is, first and foremost, a financial reward for businesses to create or improve products, processes, or software. Could be a technique, it could be a formula, it could be a technology of some sort. It doesn't necessarily need to be a physical product, as you probably gathered from the fact that it also rewards software development. But one of the things we like to say is that these activities aren't just for brand new things that have never been done before. Okay, it rewards the evolutionary steps that a company is taking towards developing that technology. Again, technology takes on sort of a generic term here for products, process, software, that sort of thing. But at the end of the day, it's financial reward. John sort of alluded to this earlier. It's really an engineering function, and it's really an incentive more so than it's a tax credit. Yes, it's a tax credit. It was the avenue that was chosen to as the conduit for this financial reward. But at the end of the day, Congress, when they instituted the credit in 1981, wanted to keep high-paying technology jobs in the U.S. So this is a way to provide those funds back to taxpayers as long as they are doing qualified research, which we'll get into here in a little bit. The credit historically has offset income tax. So the gist of that is that you had to be profitable, or you had to be paying taxes. You had to have taxable income. And so companies that were at a loss, or maybe they're startups, couldn't really benefit from it historically. As of 2016, though, this changed. Now companies, certain kinds of companies, size and revenue size, can use the credit towards payroll taxes. So this opened up an avenue for a lot of companies that historically just really didn't pay attention to R&D credit that much. So potentially some of you guys might be in a situation where you started a couple of years ago, and you maybe have limited income tax at this point and have thought, well, I don't know if I want to go into a process to identify R&D tax credits if I'm going to have limited use. A couple of things. One, it carries forward for 20 years at the federal level. The states can vary, but it's generally somewhere between 8 and 18 years. So from an income tax perspective, if you can't use it now, you can carry it forward. And at the federal level, you can carry it back 1 year as well. So there's other potential ways to use it against income tax. But if all else fails and you're still sort of within the first few years of revenue, within the first 5 years to be specific, you can actually elect to use the credit against payroll tax, which if you have employees, you are paying payroll taxes and you can get a benefit for that. Okay. And again, the credit's been around for quite a long time. There's a lot of history on it. There's a lot of regulation. It is a permanent credit now for a long time. It was on one of those extenders, preferred tax credits to get renewed every couple of years. That hasn't been the case since 2016. Now it's permanent. We do see changes to it, increases here and there, or ways to make companies more eligible, that sort of thing. So it's still a constantly changing landscape, including the Section 174, which we'll talk about here in a second. Constantly changing landscape of tax and legislation, and in some ways regulation. The last layer of that is, which again, there's quite a bit of history on this, are the court cases. That becomes case law, and it helps support certain decisions that are made on a taxpayer level. Okay, what is the impact for companies? Obviously, it lowers tax liability. Okay, which in turn should generate cash flow for companies. Okay, so the less you pay, of course, the more you have to invest in either hiring new people, purchasing equipment, investing in the business in general to continue to grow that. Okay, again, as an incentive, that's really what it's there for, is to allow businesses to take advantage of the credit first of all, and then put that towards potentially more R&D here in the U.S. Okay, and then particularly for government contractors, since at least some of the folks participating here today are going to be tuned into that, For government contracts, there's the extra layer of whether or not an activity qualifies, and it really pertains to the type of contract. This may be a reason why you've been told in the past that you don't qualify. So we'll highlight this when we get to that point. But here's the kind of the general buckets of where R&D, eligible R&D might be for government contractors. First of all, IR&D. The polling question had that sort of inferred in there. Your IR&D will be most likely qualified research for this credit. So you can take the associated expenses. Your bid and proposal buckets, okay, that may not be as obvious here, but it is also includable. Okay, your cost overruns, those would be at your financial risk. You're not getting paid for those necessarily, not directly anyway. So those cost overruns, again, have great potential to be qualified research activities. And then your government awards will run somewhere between, just to keep it simple here, fixed price, cost plus, maybe you've got a cost reimbursement, a T&M, what have you. Each one of those contract types will have a potential of being highly includable or not includable at all. We'll give you some ideas of what to go with that here in a minute and why that's impactful. But the point we'd like to make here is just because you're a government contractor and technically somebody else is paying for your R&D does not preclude you from having qualified research activities, even the ones related to those contracts with the government. So not just IR&D, not just bid and proposal, not just cost overrun. Okay, we'll get into that a little bit more here.
Hey, Carlos, if you could you just explain, we had a question just about how the tax credit applies to S Corps.
Yeah, so it applies to S Corps and any other pass-through for that matter at the personal level. So the company will claim the credit on the return, the entity will claim on the return, and then at the personal level, those credits will get applied towards tax that was generated and associated with the business, whether it's a wage that owners got that they have to pay tax on, or wage and ordinary income that gets passed through to them. Any tax that's generated, that's created from the business activity can be offset with the tax credit that flows down from the entity. Okay, great question. Great question. So just a little more here on the R&D credit and this overview, just so you guys get some thoughts around whether or not you have qualified research. These are some indicators, okay? Some activities that if you've got going on in your business, you probably have some qualified research that you can take advantage of the credit. Okay, so if you have degreed engineers and scientists on staff, probably the only reason you have them is because you're trying to do something that you don't already know how to do. Okay, we'll get into that a little later. If you have patentable products and production methods, and notice here that it's patentable, not patented. Okay, you do not have to have a patent to qualify the activities for the research credit. Okay, as long as they are patentable, in other words, that you've discovered something that somebody else has not. Even though I said earlier that's not a requirement, certainly if you have done that, it is a good indicator that you have qualified research. If you manufacture a product with highly automated processes, generally speaking, that requires activity that would be qualified research. If you develop software using new algorithms, techniques, and architectures, so if you're developing a software that's not elementary, if it's something that's a little bit more complicated, a little more difficult, you're connecting things that there isn't a connection made for, or your software executes or performs an activity that hasn't been performed before, those are good indicators. Okay, if you've been awarded a government R&D project, so from the SBIR, STTR program, or even through an OTA, the purpose of those programs is to foster R&D. Okay, so we know that if you are in those programs, and if you've been awarded a project through one of those programs, the chances are the topic will lend itself to qualified research activities. Okay, so if you fit into any of those categories there, and you're starting to think, well, geez, Carlos says that if I've got these things, it's a good indication of a qualified research. But what can I include in this calculation? So here it is, 3 costs, okay? The first one, and generally the biggest one, are going to be the wages of the personnel who are directly engaged in R&D. So most likely engineers, scientists, folks who are developing the potential solutions, understanding the problems and developing solutions, okay? They can be carrying out the experiments, or they can have somebody else carrying out the experiments. They can be the ones putting together prototypes, or they can have somebody else do those things and test, etc. So direct engagement in R&D. I mentioned also the people who might be directly supporting that R&D. Again, people who are putting together the prototypes, testing those, but not necessarily somebody who's coming up with the solution themselves. And then the last category of wages would be people who are in direct supervision of R&D. These would be first line supervisors to people who are directly engaged. Okay, so maybe there's a manager who has technical input or technical discussions with their engineers regarding how to solve a problem or how to go about a potential issue to resolve that. And so typically people we see in R&D might be PIs, principal investigators, might be engineers, managers with technical input, as I mentioned, but then again, technicians, production, assembly personnel, who may or may not be really that R&D versed, but they are supporting the process of putting together a prototype for them to then be subsequently tested. Okay, so that's labor or wages as the first category. The second category are materials or supplies, as the code calls it. These are materials used in that R&D process. I mentioned prototypes quite a few times already now. That's sort of the obvious place where there might be some materials going on, or qualified materials going on. So if you're putting together those prototypes, or the pilot model, as the code calls it, those materials will be qualified. If you've got a process that's the topic of your R&D, and you've got some materials that you used to test that process, that would be qualified as well. And then a few things that come up quite a bit as well. So for example, pilot runs or first article runs, those are still very much part of a process of validating a particular design and or process. So from that extent, you still have a high level of technological risk that's being worked on, that's being evaluated. So those runs can be included as well. And then the last one that's not very obvious at all is software that's used in R&D. These are software packages that you use to develop or design a new product, for example. So things like SolidWorks, AutoCAD, etc., that you have to pay a license to use, those can be included as part of your R&D process. And then the last category here are subs and consultants, or outside contractors in general. Generally speaking, people who are you paying outside of your company for doing performing activities or doing work that ordinarily an employee would perform. Okay, so it could be design, development, testing, coding, any sort of outsourced activity that you couldn't do internally because of capability or capacity. And again, I mentioned software here. That's a pretty common one. You go outside of your company to get resources to do the things that you guys need to do. Okay, those 3 are the expenses that go into the R&D credit. So as you noticed, you may have noticed, is we're not including travel. We're not including a wide range of other direct costs that you might also include for your government contracting, for example. We're not including, well, I guess this is not as obvious, but I'll tell you, not including fringe benefits and payroll taxes and things of that nature. We're really talking about direct costs associated with the project, okay, minus travel, meals, etc., those kinds of expenses.
Hey,
Okay.
Carlos,
Yeah.
we gotta ask a question on this in terms of these SBIRs.
Yeah.
When wages and materials are already billed to the government contract, what tax credit can be taken? And the concern is about being paid twice for about the same work.
Yeah. And I would like to say that you shouldn't confuse tax with common sense. Okay, maybe that makes a lot of sense conceptually, but it's just not how it works in the R&D tax credit world. And trust me when I say this, and we can provide you a letter of the case, but The court cases, the regulations in some way, but the court cases certainly have expanded this topic to a level that we understand that even if you got paid by the government for labor, in this case for labor and materials, for example, that is not enough to preclude you from taking advantage of the credit on those same expenses. Okay, again, there's many cases that deal directly with that, particularly the two that are most central to this topic are the Fairchild and Lockheed Martin case from the early 90s. Those two cases dealt exactly with those types of situations where those companies were contracted by the government for R&D type projects, and they were getting paid by the government, but they still got to take the credit, and the courts upheld that decision. They got to take the credit on those expenses as well. It really comes down to, and I think it's probably a good segue, John, if I didn't answer the question fully, I'll come back to me when I give the following explanation here, because I think it's a segue to go into this portion of the presentation here. It really comes down to, and I'm going to go ahead and just show you all three of these, really comes down to whether or not you as a government contractor, if that's really what we're talking about here, right? Somebody who's doing work for the government. If you have the financial risk, you maintain the financial risk of that activity, that expense and that activity. And if you have rights into the research results. Let me explain those real quick. So if I'm in the middle of executing a contract for the government, and my payments are tied or contingent upon the success of my research activity. In other words, I have to perform my research activity well, or I have to deliver on a particular milestone that contract might have. If it's a phase 2 contract, I might even have a proof of concept physical product that I have to deliver. If my payments are contingent upon the delivery, inspection, and acceptance of those items, then my payment is contingent upon success, as seen by the regulations of the credit and the court cases that I mentioned earlier. Okay, so in short, payments are made upon a milestone or some other deliverable. The payment is not just simply a reimbursement of your costs. I'll go to rights here in just a second, but let me try to answer the question that was asked earlier in this way. If you got paid by the government for performing a service, or again, delivering a proof of concept deliverable of some sort, if you got paid for the success of that or for the delivery of that, and you weren't just simply reimbursed for your hours of work, then you were absolutely at financial risk, meaning if you had not done that, you may not have gotten paid. Okay. If, on the other hand, your contract stipulated that what you had to do was spend time, X amount of hours, and report on what you were able to do on those hours, that might be more of a cost reimbursement or a level of effort type of contract. In those types of contracts, you do not have financial risk. You are simply, or a time and material contract is really common as well, labor hour contract. You're really just getting paid for expending hours. The results of the research are not the central focus of determining whether or not you got paid. Okay. On the right side of things, that's a little bit simpler from SBIR perspective, but I'll explain that just in case folks are also dealing with other types of commercial contracts that really have not necessarily anything to do with the government, and or a government contract through an OTA or some other avenue that's not the SBIR program, that's really heavily regulated by the FAR clauses, or heavily driven by those FAR clauses. Okay, the FAR clauses make it somewhat straightforward from a rights perspective. But what the rights requirement means here is that you have to, at the end of the process, you have to be able to reuse that technology or reuse the learning. Okay, the regulation calls it the results of the research. You must be able to reuse the results of the research in a different project. Okay, or you would be able to, even if you didn't have another customer. That's literally what happened with the Lockheed project. Lockheed didn't have another customer they could service besides the U.S. government in this particular project. but the courts determined that they had enough rights because they had sufficient rights to service their customer, the government, without having to pay the government a royalty. Okay, that's most likely going to be the case with 100% of your SBIR projects. If they are SBIR project with a government agency, that's the way that the SBIR CTR programs are designed to be, is to give you a share in that, in those rights as well. The government gets their government rights, you get the ability to do something else with that technology as well. So the rights isn't as big of a deal here from an SBIR perspective. Again, commercial OTA, that may get a little more flexible. Some of these bigger government contractors, integrators, for example, they might have their own T&Cs, their terms and conditions, that might say something different. Okay, they might call out rights in a different way. So it's good to be attuned to the fact that you do still have to have rights into the research results. If it's a commercial contract, if it's some other avenue that's not the SBIR program, you might need to be a little more tuned in, and you might be looking at those clauses and evaluating, do I actually have the rights to this research activity? Okay, yeah, go ahead.
Yeah, I was gonna say there's along with that, one of the questions was, many of the current OTAs require unlimited rights to the IP. How does this work with the rights requirement?
Yeah, and that's okay, guys. You can share the rights. You can share the rights. They can have unlimited, you can have unlimited. You can have some, they can have some. What you can't have is none. As the company taking the tax credit, you cannot have no rights. You cannot have no rights. Is that right? You can't have rights.
You have to have some.
There you go. You
stake
have
in
to
it,
have
yes,
rights.
in order to get the credit.
You have to have some rights into the research results. Yes, absolutely.
Yes,
So
this is a question that we get a lot in the IP and data rights space, especially with the OTAs. For this audience, we did an education training on this previously, and I think one of the things that's a big pull for OTAs is the fact that they can negotiate some of these rights, but usually when you come out of the gate, your primary your customer's like, hey, we want all the rights. So that's a negotiating factor, but they do tend to want all of them.
Yeah, absolutely. And we help with that as well. We see quite a bit of that, Meg, where our clients are in the middle of the negotiation phase. We ask them to include us in those conversations, because often we can at least refer them to a language in a contract that might be a little more favorable or at least workable in there, to where, yeah, they're still getting the R&D credit, but they're getting a portion of the rights that maybe the OTA doesn't bother the OTA or doesn't care that much. If you let them, here's what we see, for example, with Lockheed or Raytheon, very common. If you just let them insert their standard terms and conditions without asking or questioning, a lot of these guys are just putting that in there as standard. They don't even think about the fact that you might want some rights as well, or you might have a preference here. Some of them might be a little more forceful, but a lot of them are just operating out of SOPs that these companies have.
Right, but that's a really great resource. So thank you for mentioning that, because I wasn't sure that I was aware that you all did that as well. It's always nice to have that in your back pocket.
Yeah, I mean, we're not attorneys, but we do get to see literally thousands of contracts every year. So we've seen a few versions of how to do this in a graceful way.
Hey, Carlos, another question here about rights in terms of contracts require government purpose rights. I think the question here is, what rights are left for the company in that situation? Yeah,
I mean, generally speaking, and again, we're not attorneys, but generally speaking, the contract that will require government rights does not take rights away from you. Okay, you can still continue to modify and create derivative works out of those out of the research activity that you performed, okay, without infringing on those government rights. Generally speaking, the government rights just allow the government to take what they've got from you and take it someplace else, to have it continue to be worked on or expanded on, etc. So they're not necessarily precluding you from doing additional work and additional research that moves the technology forward and further. Okay, I just want to go back to the first card here then real quick, because the 4-part test, just to complete this slide here, the 4-part test is what defines qualified research. Okay, the technology must be, the activity must be technological in nature. Okay, so we're talking about research around the hard sciences, no research in the soft science. We're not talking about marketing research, for example. We're talking about research based on engineering, physics, chemistry, biology, and computer science. Okay, that activity has to have a level of technological uncertainty, meaning we as a company don't know how we're going to get to the end result. Okay, we've got a few ideas, we've got a few solutions. This is the business we're in. This is the technology we know. This is our core competency. We think we can get there, but do we know exactly how we're going to get there? Are there questions related to the appropriate method, design, or capability? If so, from a technological perspective, if so, then you've generated a level of technological uncertainty that will require, number 3 here, a process of experimentation. Technological uncertainty are the things I don't know. The process of experimentation involves creating one or more alternative solutions, validating those either physically and or virtually, simulating them, okay, and then iterating through those ideas to get to your desired end goals, okay, which could be not, I don't want to confuse you guys, but the answer to your research could be no, it can't be done. Okay, that is successful research being performed. I came up with a few ideas, we tested them, we iterated, and it turns out you can't do it with this technology, or you can't do it at these tolerances, or you can't do it at these particular parameters. Okay, that is still a successful research being performed. Okay, a lot of times we hear from our clients saying, well, but in this phase 1, it didn't matter if we were able to do this or if we weren't able to do that, we were still going to get paid. Well, not so fast. Okay, research, the nature of the research process is the answer could be yes or no, and that is the successful completion of your research. Okay, by definition, research is going to have some form of technological uncertainty related to it. The last part of that 4-part test, again, what defines qualified research is that the activity is for permitted purpose. Permitted purpose, the way I like to describe it is, it relates to a measurable aspect of that product, process, or software. So fit, form, function, quality, reliability, durability, things that I can measure in some ways, okay, or identify, or for example, a function, right? I can tell you that it does this and it didn't do that before. So it has to be something of that nature. If the activity involves solely the cosmetics, aesthetics, taste, and seasonality, that is not a permitted purpose, and those activities would not be considered qualified research. Okay, so at the end of the day, give you guys a few indicators of what might tell you that you have some R&D, qualified R&D going on, but the 4-part test is really what determines whether or not that activity is qualified. If you then have the financial risk, bear the financial risk, and you have rights into the research results, you can include those 3 costs we talked about: the wages, materials, and outside contractors. Back to the 3rd slide or whatever it was, where we had that little pie chart with the government contracts and IR&D. In an IR&D situation, yes, you have the financial risk. Yes, you have the rights. Bid and proposal starts to get a little squirrely there, but I can tell you, yes, you do have the financial risk. Nobody's paying you directly for the bid and proposal. I know there are indirect rates and you feel like you're going to get reimbursed for it, etc. Yes, but the regulations are so clear on this that you are not getting paid directly for those hours. So you are at risk. You may or may not get that contract, okay, but you are performing what is the beginning of R&D activities, conceptualization of ideas, and you're putting them down in the proposal and so on. So bid and proposal, yes, included. Cost overruns, again, it should be somewhat obvious there on the financial risk. You are not getting paid. You're over your limit. You're not getting paid for those. The rights situation we talked about, most likely your SBIR contract will already give you the rights, at least share it with you. Okay. And then on a contract, from a contract perspective, I gave you guys a little bit of an example there, but it runs somewhat like this. Okay, your T&M contracts are probably not giving you a financial risk. Okay, again, rooted in case law, very, very strong as recently as 2013 with the Geosyntec case. So very strongly, T&M are probably not going to give you financial risk. And then you sort of run the gamut from there to all the way to FFPs. So you got CPFFs in the middle somewhere in there where you get a little bit of this, a little bit of that. You got some cost shares where, well, you know, I got my portion that I'm financially at risk for, but then somebody else matches it. Okay, then maybe that portion is not a financial risk. So you got now you get a little bit more, all the way up to the FFPs, where you really only get paid once you deliver on the stipulated milestones on those contracts. For those contracts, you're most likely 100% at financial risk. But again, it depends on the situation and the contract clauses themselves. Okay, that gives you guys an idea. So for those of you guys that said, look, I don't know anything about the R&D credit, or yeah, I know something about it, but I've been told that we don't qualify. Now you know some things. You know that most likely you have R&D if you fit into this category of the indicators that we talked about. If you fit into the 4-part test, you may or may not be performing some of these activities under contract. If you are, now you've got some ammunition as to what could qualify and what doesn't qualify from a contract perspective, the financial risk and the rights. If you've been told, our experience is this: if you've been told you don't qualify for the credit, it's most likely not because you're not doing R&D, because you guys know if you are or aren't doing R&D. You just know that the activities are most likely going to qualify, even if you don't know the definitions of R&D, right, for the credit. But you probably were told you don't qualify because you do work with the government. Again, now you know. So that covers 50-60% of you guys in this presentation, whether or not you were taking advantage of the credit. A few more questions now that you could be asking your accounting firm or somebody, a specialist like us, to help you determine what level or what magnitude of R&D credit you should be pursuing.
Hey,
Okay.
Carlos.
Yeah.
Just a question here, just for an FFP contract, if the only deliverable is a monthly report, but the report must be accepted before payment is made, does that qualify as financial risk?
Yeah, I mean, yes, that's the nature of most FFP for phase ones. Yeah, that report constitutes a deliverable for which you have to perform qualified research, and your payment is only available to you once you deliver on that milestone. Perform the research and deliver the milestone. Yeah. Okay, so moving on to the last thing here before we jump into questions. There have been some recent changes to the tax code. Okay, in January of 2022, the IRS instituted it's called the additional documentation requirement. What this means is when you go to file a amended return with a claim for credits, for R&D credits specifically, you also have to file a list of what projects were worked on, who worked on them, what research activity they performed, and what information they discovered that was uncertain to begin with. So back to that technological uncertainty. This is a new requirement. It has not been around for a long time. It has not been around certainly since not since the beginning. Okay, this is obviously created to make it a little bit more difficult or onerous for taxpayers to take advantage of past tax credits or tax credits in previous tax years. This requirement does not apply to activities or costs and the tax credit calculation for a original timely filed return. So if some of you guys are still working on your 2022 tax year, for example, and you have not filed that return yet, you are not subject to the additional documentation requirements. Okay, only for amended returns. It's still attainable. You can still get credits. Some of you guys will have very good records, will have time tracking, which makes associating people with projects easier anyway. So it's totally doable, completely doable, but just so you know where this thing is headed. Okay, eventually I think the IRS is going to require that this be the case for all tax years. That's a recent change. And then the most recent one really went into effect this year. For this year, I should say, for tax year 2022. It's been around since the Tax Cuts Jobs Act, but it didn't go into effect until tax year 2022. This one is explained this very quickly here, but it is a rabbit hole. So probably a lot of questions will come out of this one, but let me just give you the gist. This actually relates to section 174. The R&D tax credit is coded under section 41, not 174. But 174 relates to research and experimental expenditures, or in other words, research expenses. The R&D credit, section 41, takes advantage of the definition of research that section 174 provides. Section 174 has been around since the 50s. So section 41 leveraged that definition and said, hey, if your activity has expenses that are categorizable under 174, those expenses are also includable in the R&D credit calculation. Okay, fantastic. And that's been the case for a long time. Section 174 historically has allowed taxpayers to expense those expenses or deduct them in the year that they were incurred, or amortize them over a period of 60 months. With the Tax Cut Jobs Act, the ability to deduct 100% of those expenses is gone. Okay, now all companies that perform R&D, regardless of whether you choose to take the credit, the R&D credit or not, this is, hey, I perform R&D, I have expenses associated with the R&D activities. You are subject to this new law. And this new law now requires that you amortize your R&D expenses. Again, it's a 60-month period, and the amortization schedule works out like in the middle of the page there. You get to deduct 10% of those expenses in the first year, 20% in years 2 to 5, and then another 10% in year 6. So this first year, 2022, you really only have 10% of your research expenses available to you as a deduction. Next year, you'll have 20% of this first year, and then 10% of 2023's R&D expenses, and then so on and so forth. Here's the gist of all this. From now on, if the law stays, and it is the way it is today, okay, so if you are going to file your return and you have R&D expenses, you must comply. So if the law stays, what this ends up generating is more tax liability because it increases your taxable income, okay, for companies that are performing research and development, which makes the R&D credit all the more useful because you now need as many, I should say, devices to reduce your taxes possible. The worst possible situation or worst possible scenario is that you comply with 174, so your tax return is correct. You comply with 174, and you now have only 10% of those research expenses available to you as a deduction, but you do not take the R&D credit. Now you just got more tax and no way to offset that. Okay, that is it. Again, new law effective 2022. It is the law now. So if you file a tax return, you must comply with it. And the good news is, one, I just mentioned the R&D credit can offset that. And the second good news is that if you are doing the work to capture the R&D credit, the work to capture 174 to calculate it correctly is 95% done. Okay, there are only a few additional expenses that go into 174 that don't go into the R&D credit calculation. Okay, so you can kind of kill two birds with one stone there. Okay, and I'm sure there'll be a lot of questions here. I'd be surprised if there aren't, but John, if you want to hold off just for a second here.
Yep.
We go through this last slide and we'll go to the questions, okay? So the action plan, guys, from our perspective, we, again, been around for a long time. We see a lot of people spend a great deal of time trying to decipher what they should and shouldn't do about the R&D tax credit. They go in and ask their accounting firm, and the accounting firm says, yeah, we don't know, we're not specialists, we don't really do this, but we don't think you're qualified. Or yeah, you should take a credit on the IR&D. That's the only thing you're qualified for, etc. You can spend a lot of time in this rabbit hole, and as you guys probably can see, there's a lot of twists and turns here. This is the reason why people like us exist, right? Is to take this monkey off your back, to take it off your plate, and to handle it and let you focus on the business and let you focus on developing the technology through R&D activities. Your accounting firm, it can provide you a great deal of benefit on the areas that they do well. But the R&D credit is really, as John mentioned, rooted in engineering. Okay, at the core of this R&D credit, you guys can probably see here the definition of R&D, for example, and everything that goes around it is really an engineering question, as we like to say. At the core of it, there's an engineering question. The IRS uses degreed engineers, and so do we. Okay, so from our perspective, we feel like our approach, the engineering approach, is better, more efficient, and more thorough to not only capture, but also to provide a basis of defense to bolster your audit defense. Okay, from our perspective, we always go about it to identify the right scope of R&D activities and to create a case, a defense or report that can provide all the answers that an IRS auditor and engineer would be asking at the beginning of that audit process. Okay, so from our perspective, it's working hand in hand with an accounting firm that knows what they're good at and knows what they should be advising on, and letting a specialist take care of what happens to be a very niche area of the tax code. Okay, with that said, any other additional questions, guys?
Yeah, I'll jump in here. I want to make sure we're all clear on the 174 piece, because it has created, as Carlos said, we are helping companies understand that it's there. But in reality, when it comes to what we do with Section 41, that's unaffected. So at the end of the day, it's affecting people's tax liability in some cases, or in most of the cases. But the R&D piece of it is where our focus is on getting that maximum benefit to offset those potential gains. So like one of the questions in here, there's a few, but it was kind of just disagreeing with the interpretation of Section 174. It says Section 162 still applies when you are carrying on a business, for Section 174, which are expenses in connection with the business. So more of a statement there, but just wanted to add that.
Yeah. Yeah, I mean, 162 is still going to apply to a lot of things. But again, the 174 comes down to a definition of R&D. So if you go back to R&D from a 174 perspective, whether or not those are revenue producing activities, if you want to call it that. So in connection with a contract, it's really the nature of the activity, not the end use of the activity, if that makes any sense. There's a lot of things that can be made an argument that it should be 162, particularly if it's not, strictly speaking, just R&D. But by and large, if you are including something as Section 41, the R&D credit, you have very little argument for not included as 174.
Next question is, can a company end up having taxable revenue from an R&D contract, but a direct cost for wages that is a 174 expense that must be amortized?
Yes, that is absolutely the case. Absolutely the case. And then you also, in that particular case, you also have an R&D credit associated with that. So revenue, direct costs, calculate an R&D credit, and then those direct costs will also constitute your 174.
I'm going to skip this one question and come back to it, and then, but just, are there requirements to increase R&D year over year to claim the credit?
Yeah, obviously that question from somebody that's been there before and understands it. So great question. Are there requirements? Kind of, sort of. So let me just give the background real quick. The credit, traditionally called the credit for increasing research activities. The mechanics of the calculation of the credit sort of creates this need to increase the level of activity or the expenses year over year in order to continue to generate a credit. Okay, sort of. I say sort of because the real math of it ends up being that you can kind of stay flat and still generate a credit. In fact, you can dip a little bit and still generate a credit. Now, you can't just fall off a cliff and go from $1 million of qualified expenses to 100 the next year. That is not going to allow you to generate a credit. But the mechanics more or less works like this. There's 3 ways to calculate the credit. I'll just give you 2 here. One, the simpler one to conceptualize, called the alternative simplified method. The alternative simplified credit method, the calculation is based on how much this year's expenses exceed half of the average of the last 3 years. Okay, so in a way, because it's based on the excess expenses, yeah, there's this kind of understood thought that you have to be increasing, but it's really only half of the average. So if you stayed flat, your average was $1 million, and this year I generated $1 million, I only have to exceed half of the average, which would be 500,000. So my excess amount would be 500,000, and I would generate a 14% credit on that. Okay, so if I stay flat, and again, if I come down all the way to 600,000, I'm still generating a small credit, albeit, but I'm still generating the credit. So to answer your question, no, not necessarily. You don't have to be increasing every year, or you're not going to generate a credit. But it certainly is based on a comparison, a level of activity and expenses in other years. Yes.
I'm going to go back to that question originally. It was like just in terms of how we charge as a contingent on credits. And I think I'm not going to we can delve into how we charge, but I think there's a bigger concept here that's really important for everybody to know. And it's in terms of contingency based for this credit. If people are charging that way, we always say run. And then Carlos can go into why.
Yeah, I'll go into why real quick. So we practitioners before the IRS, in other words, enrolled agents, CPAs, attorneys that talk to the IRS and that defend, in particular, that defend clients before the IRS must abide by what's called Circular 230. Circular 230 is sort of this internal regulation for practitioners. If you're going to practice again, you have to abide by these rules. And one of those rules, and this has been around for a long time, since 2007. Just people choose to not pay attention to it. Okay, but anybody who's around can tell you about Circular 230. Any one of your accounting firms would say, yeah, I know about Circular 230. Circular 230 precludes providers from charging a contingency fee or a fee based on the success, as what a lot of firms or some firms call it. So we don't. We charge a fixed fee based on the scope of the project, what we have to do. We know government contractors really well. We've been doing that for the better part of 18 years. So we know how to scope that project in a way that makes sense for us and obviously makes sense for you guys. In other words, we know exactly how many hours it's going to take to do X, Y, or Z, depending on the size, how many contracts we got to review, those kinds of things. But that's the way we choose to work. In a very rare occasion, we work under an hourly engagement, but that's pretty rare. We find that it's not a great incentive for our clients to just let the bill run, so to speak, right? But no contingency, no.
I'm not ignoring the one. I know we got time for one and we got two here. So we'll see if we can get through them both here real quick. But does R&D cover non-increasing revenue? Just as an example, would be an improvement of processes or materials where revenue would not change significantly with that. Yeah.
Again, it comes down to the nature of the activity. If it fits that 4-part test, then you can take the expenses associated with it, the 3 categories we talked about, and calculate a credit based off of that. Yep.
And then the last one, we got one more in here too, but I want to make sure we get them. We might be pressed for time, Meg. You tell me. So
I think we can do them we'll handle both of them real quick, and then we'll kind of wrap it up for the day.
Okay. Can I do the last one real quick? Because I think that's the easy one, John.
Yeah.
Do that real quick. So on that one, talking about satisfy half the average. That question is asking about revenue. We're talking about expenses, qualified research expenses. You must your qualified research expenses for, say, 2022 must overcome half of the average of the expenses, research expenses in the last 3 years, not revenue. So you're okay. It's possible that you had half the revenue, for example, a company might have had half of the revenue, but continue to do R&D and spend money doing that, either through private investment or self-funding, that kind of thing. So the two things may not be connected to begin with.
And then, yeah, this is the last one. I think it's just more the continuative discussion on the section 174. You know, company that is doing contract research for the government doesn't have to select section 41, which
True.
R&D credit is an election. Absolutely.
Yep.
They can use section 162 if it's a business model doing research for the government. It would then, you know, I think the point here is you don't have to do section 41, and that's 100% true. I think what we just suggest to folks is if you're going to have tax liability and it's an election, you have the election to reduce that number too.
Yeah, I guess you know, I would challenge that in this way. Again, our position is, and our position is not aggressive in either direction, if that makes any sense. We try to be as sensible as we can here, but our position is section 174 really applies to the nature of the activity, not necessarily how, and again, that's how 174 reads. So I would challenge that in this way, that, you know, as you go back and read through section 174 and identify the finer points of that, whether or not 174 applies to a particular business model or a particular type of activity, okay, or the nature of an activity, as I keep saying it. So from our perspective, 174 really delineates or sort of describes a particular activity type that if you are performing that as a taxpayer, that you would be subject to, not necessarily, you know, whether or not you're making money off of that research, or if it's more of a basic research, etc. Those are not implications in section 174 from where we read. So if that's a case, or if that's an argument that's going to be made, I just would challenge to make sure that as you go back to 174 and even 162, that you find letter of the law and regulations that really gives you a foundation basis for that. Otherwise, what could happen is you get in an audit and now you're trying to convince somebody who otherwise has an agenda to actually get you to pay more tax. So get the facts and get the basis straight before you get down the audit rabbit hole, because when you get to that point, you've got a very adversarial person on the other end of that.
Perfect. And that's why it's really a great idea to have people in your corner who do this for a living. So any questions like that can always be directed appropriately, as we should. Thank you, Carlos and John, and everybody in the audience who stayed with us today. You can connect with any of us on LinkedIn to stay in touch. As a reminder, if you're planning to attend Sierra Space at the National Harbor, April 4th, Soft Week in Tampa, May 10th, or the Geospatial and Intelligence Community Matchmaking that we're hosting in St. Louis on May 22nd. We're doing matchmaking at all of these places, so if you're going to any of those, reach out. We're also hosting our next ATI training and education webinar on the process to relationship ratio on May 17th. So for any information on those, you can email ati@govmates.com. We'll give you all of that. A bonus reminder, if you did not check your email already, your GovMates profile now has a place to note your CMMC readiness. And if you log in between now and April 21st and update that with that information, you'll be entered to win one of several Yeti coolers. So fun little plug there as a reminder. So head to govmates.com/membership to take care of that. If you find you have additional questions or want to continue the conversation post-webinar, please let us know at any of the emails here. And we hope you have a great week and look forward to seeing you either in person or online at one of our upcoming events. Gentlemen, thank you very much.
Thank you.
Thank you.